You can have very high debt with low interest rates, or you can have low debt with high interest rates. But very high debt and higher interest rates is a recipe for trouble.
Welcome back to BVTV. I'm Peter Thal Larsen, the global editor of Breaking Views, and joined again by Hugo Dixon from West London. Hi, Hugo. Good to have you back.
Hello, Peter. Lovely to be with you.
So the topic this week is global debt. You've been looking at the buildup of debt around the world since the financial crisis. Just to start the conversation off, just give us a bit of a context in terms of how big those numbers are now.
Yes, well, okay. So if you look at non-financial debt, so companies, households, and governments, that's gone up from, according to the IMF, from 195% of GDP at the end of 2007, just the year before Lehman went bust, to 256% at the end of 2020. So that's quite a big increase. And you'd have thought that one of the lessons we would have taken from the global financial crisis is that we don't want too much debt in the system. Well, in fact, it's gone up, not just in absolute terms, but relative to GDP, which of course has also gone up in that period.
And it's gone up, I mean, certain parts of it have gone up more than others, right? So the government's borrowed initially to recapitalize the banks and sort of, help people out after the financial crisis. And I guess more recently with COVID and then now with energy bills. And I guess we've seen also a bit of increase in corporate borrowing. Are those the sort of the two big ones? They
are, and I think that certainly in the West, the governments are really big, and in China, it's the corporate sector and the sort of property sector which has been the real ballooning. In fact, the Chinese debt as a proportion of GDP has virtually doubled in that period. And of course, Chinese GDP has also gone up a hell of a lot. So a huge amount of that debt is actually increased in China, so much so that China, before the financial crisis, had as a whole had low debt, but it's now, almost up to Western levels in terms of debt to GDP.
And so I suppose sort of the rejoinder to that is to say, well, does this really matter? I mean, the governments have taken on a lot more debt, but, on the other hand, central banks have been buying a lot of bonds. Interest rates have been pretty low. Is there anything really to worry about, or can the world actually live with higher levels of debt now?
Well, I would actually blame the central banks for keeping interest rates so low and the quantitative easing which was not just used in emergencies at the financial crisis and in the pandemic, but you had low interest rates for the entire period in between. And so that is one of the reasons that debt has gone up, not just government debt, not just in those countries directly with QE programs, but it's spilled over into all sorts of other financial markets, emerging markets, corporate debt markets, and then speculation. And we've seen it in the pension funds in the UK that have got themselves into a tangle because they've been leveraging themselves up. And so I think that the problem is that those low interest rates were not sustainable forever. And literally now they are on the up. And it seems to me that they're going to go quite a bit higher because you've got to get inflation out of the system. And the problem is, it's one thing, you can have very high debt with low interest rates, or you can have low debt with high interest rates. But very high debt and higher interest rates is a recipe for trouble.
I mean, you hinted at some of the trouble we've seen sort of in the UK last week with the pension funds. I guess we've seen some problems in China with the property sector, very over-leveraged property sector, sort of an adjustment going on there. We've seen a few other bits and pieces, but sort of play that through a bit. I mean, if we are in the situation where debt is very high and interest rates are going up, where should we be looking for the next set of accidents?
Well, I think you have to think of how it's likely to play out. I mean, there are various ways that debt problems can be dealt with. One is that you can actually have debt defaults and debt distress. It's like the Asian financial crisis or the Greek crisis. And we're seeing that in some markets at the moment, like Sri Lanka and Ghana and Pakistan, et cetera, et cetera. Okay, not yet big I mean, Pakistan's big, but it's not yet systemic countries that are being dragged into that. There is a possibility that you'll see that in some of the developed countries. Italy is still a problem. Greece is still a problem. We've talked about those, and it's the question of whether those debts are sustainable. But then the other way that you deal with debt is through basically suppressing, because it suppresses growth, and this is what you're seeing in China. And you either deal with it through raising taxes, tightening belts, or if you're a company not investing. And so this acts as a sort of long-term or medium-term drag on growth. So I think that the 2020s, it's not just the problem of the COVID and the energy crisis, but debt is going to be something that we're working through the global economy throughout the 2020s, and it's not going to be a good, we already were seeing that the growth outlook wasn't that good, and so that's going to make it an even worse outlook for growth, global growth.
Yeah, I guess historically the world has sort of dealt with these big debt problems partly through inflation, and I guess we do have quite a bit of inflation, having not had inflation for a long time. We have quite a bit of inflation now. Will there not be a temptation, do you think, in many countries to say, well, let the inflation run away a bit and inflate away some of those debts?
Yes, but and this really then depends on what happens with the markets and how much the markets wake up to this, and how much. And I think that we had last week a warning sign in the UK. And if you want to say, one of the good things that happened last week was that the bond vigilantes woke up as far as the UK was concerned. And that has not only produced something of a U-turn by the British government this morning, but it will be seen as an object lesson for other countries around the world, that you can't buck the markets, at least when they've woken up from their long QE-induced slumber. So I think if you say compare it to what was going on in the 1950s or 60s when you had that inflation, and in those days you didn't have so much international capital flows, and so often domestic savings were trapped, and so it was much harder for investors to discipline governments. So I don't think that inflating your way out of the problem is really going to be much of an option this time round. Okay, well, we shall see how this plays out. Hugo, thank you again for another fascinating chat, and we'll talk to you again soon.